When it comes to investing, one thing we hear a lot about is diversification. In other words, the theory that by spreading your dollars across different types of investments, you can lower your portfolio's risk. But does it really work? Let's take a look. Hi everybody, Dave Kaplan here, financial advisor with Cornerstone Wealth Management. I manage portfolios using a variety of methods to address cash flow needs, time horizon, risk tolerance, and of course market conditions and opportunities. But one common strategy that I incorporate to varying degrees across all portfolios is at least some form of diversification. So let's take a look at why this time-honored approach is so powerful. And to help us out, I'm going to turn to what I call the jelly bean chart. Now, each of these columns represents a calendar year. This particular chart begins in 2001 and goes through 2020. The colored squares represent different asset classes. Here, the dark blue square represents bonds, while the light green square stands for the stocks of small and mid-sized companies. And within each of these squares, you can see how that particular asset performed for the specific calendar year. The final column shows the average over the 20 years for each of these assets. Now, the squares are arranged with the best performing asset class at the top and the worst performer for that year at the bottom. Notice also how the leadership changes from year to year. This shifting leadership is often unexpected and dramatic. For example, during the crash of '08, large U.S. companies were hit hard, ending the year down some 38%, while bonds finished with a positive return. But what about 2009? Almost a complete and total reversal. In fact, throughout the 20 years shown here, it's difficult to find consistency of any kind. But now let's look at the black box. This box represents a diversified portfolio that invests equally in each of the asset classes shown on this chart. At no point does the diversified portfolio finish at the top or at the bottom. But across the 20 years, it still provided a competitive return. While everybody always wants to pick the winner each and every year, I believe this chart demonstrates that doing so consistently is very unlikely. And chasing returns by investing in this year's best performer may lead to some poor results. So, as we've seen here, a diversified portfolio may indeed help to smooth performance and provide a competitive return. If you have questions on what this may mean for your investment approach, feel free to give me a call or email me or contact me through my website. Thanks for watching, and I'll see you next time.